We all use it every single day, from grabbing a coffee to funding global trade, the US dollar. It feels solid, right? Dependable. But what if the very system that makes it so powerful is also its greatest weakness? What if the entire global economy is balanced on a knife's edge, all resting on a single point of failure?
This is how the source material, the dollar fault line, puts it. And wow, it's a powerful image. The network effects that once looked like elegant efficiency now resemble an airline that has routed every trans-Pacific flight through the same single runway island. It paints this perfect picture of concentrated risk, where just one little problem can cause a massive global traffic jam.
But here's the thing. That single runway island, it isn't just a metaphor. It's a very real place, a physical choke point for pretty much all the world's money. I mean, just think about that for a second. Everything from a German insurer buying U.S. bonds to a Zambian copper mine getting paid for a shipment, it's all dependent on the smooth functioning of one tiny geographic area. It honestly sounds like a plot from a Hollywood movie, but it's the actual reality of our financial system. So this is the core concept we need to wrap our heads around, the Manhattan bottleneck. We're talking about a handful of high-security clearinghouses, mostly clustered around New York City, that act as the final gatekeepers. For any major dollar transaction to be legally final, I mean truly officially settled, it has to pass through these specific physical rails. And the scale of this is it's staggering. The Federal Reserve's own system, FedWire, settles over $4 trillion every single day. This is the sovereign spine of the whole operation. And on top of that, you've got the private banking network, CHIPS. It nuts down another $1.5 trillion in daily transactions. You can think of it as the system's efficiency layer. But at the end of the day, it still has to rely on FedWire to finalize all its books. And this bottleneck, well, it secures almost everything. Get this. The system that handles 90% of all global currency trades, CLS, every single time yen are traded for dollars or euros for dollars, the dollar side of that trade ultimately hinges on these exact same Manhattan rails. It turns this one city block into a single point of failure for the entire world's currency market. Crazy, right? So you have to wonder, how did we end up building a system with such a critical and, frankly, kind of terrifying bottleneck? To understand that, we've got to look at the hidden plumbing of the global dollar. So it really comes down to these three main pipelines: the Fed's own system, FedWire, the private banking network, CHIPS, and the global currency linker, CLS. They each have a different role, but they're all interconnected, and this is the crucial part. They all converge on that exact same bottleneck in Manhattan. But here's the real twist. Most of the dollars out there in the world aren't actually created by the Federal Reserve. They're what we call synthetic dollars. Basically, dollar-like liquidity created offshore through financial instruments like swaps and repos. And they function just like real dollars, right up until the moment they don't. And this right here, this is the crucial difference. The formal rails, like FedWire, they give you legal finality. Once the money moves, that's it. It's irreversible. The law says the transaction is done. But these shadow pipelines, they only provide economic finality. It's a whole system built on trust and some pretty complex math. It works beautifully when the seas are calm, but that trust can just evaporate in a storm. So what happens when this intricate, super concentrated system comes under pressure? Let's take a look at what happens when the machine really starts to break down. Just look at how fast things can go wrong. In March of 2020, as the pandemic first hit, the system went from totally stable to a full-blown crisis in about 36 hours. First, the margin calls started rolling in. Then, the Treasury market itself, the safest asset in the world, it just froze up. Suddenly, the cost to get dollars anywhere on the planet just exploded. It all happened so fast, the Fed had to step in with these massive, unprecedented lifelines just to stop the bleeding. And it's not just market panic that we have to worry about anymore. The source warns about a whole new generation of threats. What happens when a climate disaster wipes out the collateral that's backing global trade, or a really sophisticated cyber attack just switches off the payment systems? And what about purely political risks, like a U.S. debt ceiling standoff that basically creates a default risk out of thin air? To make that cyber threat really feel real, check this out. Risk modelers at some big financial institutions ran the numbers on what would happen during a 5-day outage of the SWIFT messaging system. The result? A potential $9 trillion in payments just stuck in limbo. Trillions. That's not a market crash. That's a global economic seizure. So, given all these risks, the big question becomes pretty obvious. Can the world actually escape this dollar trap? Is anyone even trying to find a new path? Well, escaping is not so easy. The US dollar still makes up 58% of all global foreign exchange reserves. It's totally dominant. But you can also see the slow rise of alternatives. The euro is holding its own, and the renminbi, while still small, is definitely growing. It looks like the world is starting to hedge its bets, little by little. And the search for these alternatives is happening on a few different fronts. You've got regional blocs, like in Southeast Asia, trying to settle trade in their own local currencies. There's chatter about reviving the IMF's special drawing rights to use as a neutral global asset. And then you have the really high-tech approach, projects like Mbridge that are building new digital currency networks to let money flow directly between countries, completely bypassing the old system. But for now, despite all of those efforts, the fundamental problem hasn't changed one bit. The entire global economy is still tied to that single, aging, and increasingly stressed-out bridge. Which leaves us with the ultimate question, doesn't it? What do we do about this bridge? Do we just try to reinforce it and hope for the best? Do we reroute some traffic to maybe ease the load? Or is it finally time to start the long, expensive, and incredibly difficult process of building a completely new one? There are no easy answers here, but understanding the question, well, that's the first step.